Hello and welcome everyone. If you're here live, tuning in, and this is your first time, please comment below letting me know this is your very first live stream. Happy to have you here. For those of you that don't know me, my name is Denzel Rodriguez, personal finance geek of the 21st century. And today we're going to be talking about lines of credits. A lot of you are researching banks, credit unions on credit cards, personal lines of credits, unsecured, secured, business line of credit, and home equity lines of credits in the first or second position. Why are you doing this research? Well, primarily it's because you're trying to implement the velocity banking strategy, accelerated banking strategy, paycheck parking, mortgage acceleration, whatever marketing terms are being pitched out there in the YouTube online social media world. On this channel, we primarily say velocity banking is what we're summarizing as a strategy of which you all, even myself included, are using to accelerate debt faster than the traditional normal way of getting out of debt, simply making extra payments every single month. Velocity banking helps us go faster than the traditional way some of the time, not 100% across the board, but under certain situations, certain circumstances, with the right numbers, with the right line of credit, we're able to go faster in many, many cases. So that's what a lot of you are trying to do, are working on, is obtaining the right line of credit. In short, we may call it debt tool or debt weapon is what we're referring to, that debt tool to help us accelerate your debts so you can save money on interest, recover cash flow faster, put you in a better overall financial position to be able to save and invest later on. So that's what many of you are using the strategy for. Some of you are at a point where you are using your debt tool, your line of credit, to actually invest and create arbitrage in terms of what you pay in interest versus what your investment returns are and the cash flow that gets produced. So you're actually borrowing debt to purchase an asset that produces cash flow for you more than what your cost of interest is over a period of time. And when it's all said and done, you pay off the line of credit doing velocity banking with your income and cash flow. And now you have an asset that continues to produce cash flow, and you stayed liquid during that time frame. You didn't have to dip into your own capital, your own cash. You used the bank's money first, OPM, bank's money first, boom. You acquired an asset, it created cash flow, you created an arbitrage, you still have the line of credit, you still have the asset, and maybe you do that over and over again until using the line of credit becomes obsolete, or you transition into a different tool altogether, such as a cash value life insurance policy or a properly structured whole life insurance contract, which allows you to do that very same thing, just more efficiently long term. You're able to build wealth simultaneously. So, in today's session, this is a two-pronged approach. What I'm going to be presenting today is my pitch to a bank or banks, who knows. But essentially, in my 7-year career now, being on YouTube, serving over 1,100 families on a one-to-one basis, I've helped thousands of people obtain the right line of credit, whether that be a credit card, a personal line of credit, a business line of credit, or a home equity line of credit. Implement that into their personal finances and help them put themselves in a better overall financial position. And over the years, we've seen interest rates go up, go down in that in the last 7 years from 2025 all the way to 2018. We've seen rates go down, go up, and now we're in an environment today where rates are still relatively high, but they're kind of flat. They haven't really gone down, but they haven't gone up either. It's kind of staying the same right now. But we're yet to be seen if anything will change in the next couple months here. And we've seen velocity banking case studies on this channel and others in low interest rate environments and in high interest rate environments, and it still produces tremendous results. Now, what I've also seen over the years is more and more banks providing products that actually help us, the community of velocity banking practitioners, those that understand how a line of credit works, where you can effectively reduce your average daily cost of interest and save a ton of money on your fixed amortized loan rates with the various different debts, mortgages, student loans, personal loans, car loans, etc., etc. And up until recently, I've made a very unique relationship with an organization. I won't name the organization yet. I don't want to spoil it. This is me simply manifesting an opportunity. This is me pitching to this specific organization of ways that this specific organization could do business with people like us and many others to come. Because what is happening on social media across the board, across many different industries, is the customer is becoming more and more aware of what's being done to them, to their finances. Correct me if I'm wrong in the comments. We got 18 people watching and more tuning in, and those that catch the replay. Correct me if I'm wrong here. With the massive growth of financial gurus, influencers, content creators, people that are teaching financial literacy online, people that are teaching non-traditional finance, have you become more aware of how the system is treating you over your personal finances? Have you become more aware of different opportunities and possibilities of ways to operate your finances? If that answer is yes, trust me, there's millions of other people that are becoming more and more aware, specifically looking at the banking system, that the overall game is not necessarily set up in your favor for the vast majority of Americans. And there are a few select banks out there in the United States that see this problem, where you've got more and more customers become more and more aware, which means they're starting to move their business away from banks that don't serve them. Well, if there are these other banks that are proactively serving their customers, proactively teaching them financial strategies that can improve their finances. Imagine if there were banks that you and I could partner with, and there's a mutual beneficial relationship that could occur, where you, the customer, if you gain more wealth, guess what? You're going to have more money in your what? Bank accounts. If you have more money in your bank accounts because you paid off debt and you have more cash flow, then that's more deposits for whom? The bank, or banks that you do business with. So if you have a bank A over here that's never really served you other than held your money. And you know, as the customer, the banks immediately lend your money out, and they turn your deposit and they flip it multiple times over and they lend it out. Banks are in the business of lending and creating interest profits on your money. Banks don't have any money. They have your money. They leverage your money multiple times over. So they take $1 and they leverage it 10, 15 plus times over because they're able to do what's called fractional reserve lending. And they're able to make billions of dollars on all of our deposits. So as more and more Americans, more and more people become aware of this, what do they start to do? They start to pull their money out of banks. Where are they storing it? More and more Americans today are storing money in properly structured whole life insurance contracts. They're storing it in self-directed IRA accounts held in trust, held with custodians. They're storing their money in brokerage accounts. So they're taking more and more of their money and keeping it out of the banks. This is what a lot of the content creators talk about and teach. They're like, don't keep all your money in the bank because you don't know if that bank will be there tomorrow. What have we seen over the last 2 decades? We've seen a massive reduction in the amount of banks in America today. We're seeing a consolidation of banks. Are we not? Comment. Let me know. How many banks were there in 2008, prior to 2008? How many banks are there today? 2025, there's not that many banks today. That number has dropped tremendously. So, referring to the banks that are being proactive, because there's a few that are seeing the value of coaching, they're seeing the value of financial literacy and education. They're taking it to the next level. In this specific community, which is relatively small to the masses, obviously, but this community has been growing dramatically over the last few years with the helps of other content creators like Christy Van, the Kwok brothers, myself, Matthew Pillmore, Connor J. Wallace, and many others that are starting YouTube channels and building and getting this message out like, hey, there's a better way to accelerate your debt. And if you partner with the right banks and get the right tools, you can accelerate your wealth. Now, what happens is that bank that we end up moving our business to and sending our deposits, that bank makes money. So they're receiving new business that they would not have received if they didn't have the right products, the right banking products. So my pitch today is going to share some banking products that if this institution would consider creating in their bank, then they could potentially, especially with some endorsement from content creators like myself and many others, they would corner and dominate a market. That market is people who are doing velocity banking with PLOCs, HELOCs, credit cards, and BLOCs. So we're talking personal and business. So before I take it to the board, there are 5 main products that I want to focus on today. I don't have space on my board to cover them all, but it's essentially a secured, revolving personal line of credit, a unsecured personal line of credit, a credit card that operates like a personal line of credit, and then a cash value line of credit. What if we all, or what if I, could design the perfect debt tool? Is it possible? I don't know. I want to pitch you, the institution that I'm talking to. So there's a parallel approach going on. I'm pitching an organization, but I'm also talking directly to you, the customer, because I want your insight. I want your feedback on this. What if I could design you the best credit card, the best personal line of credit, the best business line of credit, the best cash value line of credit, the best home equity line of credit, first or second position? Would you consider moving your business with the other bank that you're with, Chase, Wells Fargo, Bank of America, and move to this other bank that could provide you with the best tools to help you accelerate your wealth, remain liquid, increase capital, and it's a mutual beneficial relationship? Why? Because now this bank that's being proactive is receiving deposits. In order to do velocity banking optimally and efficiently, you want to have all your income, your deposits, at the same bank where your debt tool is at. Many of you are doing velocity banking inefficiently. I'm not going to say wrong, you're just doing it inefficiently. For example, some of you have a checking account, you have your income going to Bank of America. And let's say you live in the state of Florida and you apply for a home equity line of credit in the second position at Space Coast Credit Union or Orlando, I think it's called Midland Credit Union, or Orlando Federal Credit Union, or a credit union in South Florida, maybe Bright Star, maybe Tropical Financial Credit Union, one of these credit unions that offer a home equity line of credit in the second position. You applied there, you got the tool, but you're still sending all your income to Bank of America. So this smaller credit union is giving you a line of credit so you can do velocity banking with. You open up a checking account at that bank, but you're still not sending your deposits to that bank. So what do you have to do? You have to set up an external transfer relationship. You have to connect both banks, Bank of America and let's say Space Coast Credit Union. You have to connect both banks, and you have to wait days to transfer your income from Bank of America to that credit union. Then from there, you transfer to the HELOC. Or maybe you make a payment over here to your HELOC, but you have to wait days for it to sit, registered in the HELOC, and then you move money out of the HELOC to the credit union checking account and then pay your bills from there. It's extremely inefficient. Why not cut off Bank of America? They don't serve you any longer, or Wells Fargo or Chase. They're no longer serving you. Move all your banking to that credit union where you have your debt tool at. And you're going to increase efficiency with this strategy. What happens at this point? Well, now Space Coast Credit Union receives all that new business from you. Your wife's income, husband's income, all those deposits on a monthly basis now falling into that bank. That increases the balance sheet of the bank. That increases more leverage for the bank. They're now receiving the interest that you consolidate. You consolidate your car loan to your HELOC, your student loans to your HELOC, personal loans to your HELOC, credit cards to your HELOC. So you go from high interest rates to lower interest rates, but guess what? You're still paying interest, and the interest that you pay now is going to that credit union. So they're now receiving revenue that they would not have received before. And so there's tons of banks that I'm always recommending you guys take a look at and research and qualify. I'm making all these banks tons of money, by the way. But at the same time, those banks don't even realize an even greater potential is, what if we could improve those tools that these new customers, you guys, are using on a daily? What if that was possible? And I'm in communication. Again, I got a relationship with a certain institution, certain bank, that if they're willing to hear me out, watch this video, I'm obviously going to chop it up where they can see where my head's at, what the customer wants, ultimately desires, where it's still mutually beneficial to the bank. They make their money. We're able to leverage the banking products to create wealth. The more wealth we create, the more deposits we'll have for the bank. They'll continue to make more money. And we move all of our debts that we had at these other institutions and move it with this bank. So what I want to do is start with a secured revolving personal line of credit. I think the secured PLOC is a super underrated product many don't know about. And I think banks are just asleep at the wheel with these tools, because it's a great way to receive new deposits from a new customer. The bank then gives them a line of credit, and they're now charging interest on secured collateralized dollars. This allows an individual to build their credit. This allows an individual to consolidate debt to themselves, essentially. And the bank wins because they're now getting the person's entire paycheck into that bank, because the way that I'm going to present it here. And they're now creating revenue on an existing line of credit that, again, that they would not have had in the first place if they don't create the product. So here's an opportunity. Here's what I would want if I was a customer, knowing everything that I know. A secured personal line of credit. Here are the guidelines of how I would design this tool, knowing what the industry looks like as a whole. So if you were to look for a secured personal line of credit today, the interest rate that you get is typically going to be prime plus a certain percentage point. So it's usually going to be prime plus like 2%, prime plus 1.5, and in some cases, prime plus 2+%. Quite similar to an unsecured revolving line of credit. And we can do research together right now, and I encourage you to do research with me. So open up another tab on your computer or your phone, and let's look up average secured personal line of credit interest rate today. And let's see what comes up. Let me share my screen. So we got, it says the average interest rate for a secured personal line of credit can vary, but is generally lower than that of a unsecured line of credit. This is very true. Secured lines of credit backed by collateral, like a savings account, tend to have rates between 8 and 20%, while unsecured lines of credits can range from 8 to 32% or even higher. So today we're looking at 8%. That makes sense because prime is currently 7.5%. So at the very lowest, on a secure personal line of credit today, generally speaking, you're going to have prime plus 0.5%, let's say. So that's going to be an 8% secured line of credit or higher. And what I'm presenting, regardless of someone's credit score, is what if we could design a secured personal line of credit where the interest rate was based off of prime. just prime, no plus, no minus. Then, according to my parameters here, if, and this is where my teaching and literacy would come in place to help you all, which is if we could get your credit score to 700 to 720 or higher, starting with a minimum credit line of 10 to 15,000, you set up a checking and savings with the bank that we're going to do business with. You set up direct deposit. We could have a secured line of credit for a prime minus 1%. So prime minus 1% would be 6.5% secured PLOC. And when we look at today's environment, I look at hundreds of scenarios, and I'm seeing people with personal loans in the double-digit ranges today. Credit cards are at all-time highs today, high 20s, even 30s plus percent. Student loans, 5, 6, 7, 8%. Car loans, 6, 7, 8, 9 plus double-digit percent range. And for the majority of you, you're making your normal debt payments, but what are you also doing? You're sending extra money each and every month to that debt. What if you first saved money, 10 to 15,000 or more, got a secured line of credit, and you were able to get 6.5%, and now you're using that line of credit secured by the bank. The bank gives you a line of credit, they hold your 10 to 15,000. They give you a 6.5 interest rate, and now you can start consolidating debt. And again, it's a mutual beneficial relationship. So that's the first way that I would design this tool, because I'm thinking of it from the bank's perspective. How do we also make money, right? Because the bank is in the business of making money and profit, but also rewarding the customer for certain things that they can do to increase the relationship with the bank. So again, we have a secured PLOC where it's standard. If you have under a 700 credit score, say something like that, you would have prime rate. Whatever prime is, that's your rate. And to create more incentives, we could say, all right, as long as you submit a minimum secure line of credit, 10 to 15,000, with a credit score of 700 or more, you set up checking and savings with us. Set up direct deposit with us. Set up auto pay with us. Then we can grant maybe a prime minus 1%. And then you create tiers where it's like, okay, if you have a line amount of maybe 50,000 or higher, we do a prime minus 1.5 or maybe prime minus 2%. So you go from 7.5 to 5.5 or 6%. And what does that allow the individual to do? This allows an individual to leverage their existing savings without losing it and park it with the bank, set up velocity banking, start accelerating debt faster. So that's secured. I think that is low-hanging fruit for a lot of Americans today who have savings, decent credit, but a lot of debt. And instead of going with a debt consolidation company, instead of applying for a bunch of 0% credit cards and, kicking the can down the road, you could set yourself up more securely with a secure PLOC. That's one thought. Now, under the umbrella of secured line of credits, a bank could also do a secure line of credit against assets or investments. So maybe a bank like this would be willing to give a secured line of credit against maybe your brokerage account. So kind of like a margin line of credit, but the bank would be competing with that margin line of credit. Maybe there's something there to provide an even better rate. So instead of using cash, maybe there's assets that one could secure with the bank, and the bank could give access to a line of credit. I would focus here first because this involves more work, more than likely for the bank, so I would focus there. That's low-hanging, easy fruit, and it's also great for people who may not have a whole lot of debt or have no debt at all but want to build credit. You can do it with a secure line of credit. You can build credit this way. This will report. Moving right along to the unsecured HELOC. In today's environment, I'm not seeing any HELOCs today that are below 8%. They're all 8% and higher. So there's a world where, same thing, someone has a 720 or higher, and minimum credit line 10 to 15,000 or higher, have a cutoff, maybe max HELOC of unsecured of 50,000 or 75,000, something like that. But they have to set up checking and savings. It's an exclusive in-house product only. This isn't, you can't get this if you don't do business with the bank. That's how I would want it. Like if I'm the bank, I want you to do business with me. So I'm not just going to give you an exclusive product like this to anybody. I actually want to do business with each and every customer. So I'm saying, look, my parameters as the bank, but also the perspective of a customer, is if I can show good credit, 720 or higher, DTI, maybe 45% or less, something like that. Minimum credit line has to be like maybe 15,000 higher. You have to open up a checking and savings with our bank, and you have to set up direct deposit with our bank, at least 50% or more of your income, sending over here. Then, same thing, we could do a prime plus or prime, no prime minus. Prime minus maybe would exist for secured HELOCs only, because remember, the bank has to make their money. So prime plus. So it would be prime, flat, you have to meet certain standards to get that. And it would be for only good credit scores and good credit worthy folks, prime lenders, prime borrowers. And the way we get to prime is by meeting all those standards. And if it's a prime plus, that's because of, say, the person's credit score. So the lower the credit score, the higher the prime plus rate. And it would go up by increments of, say, 0.25, 0.5%, something to that effect. And then the max, the credit line, the max personal line of credit, this is where it'd be even more advantageous, is there's a cutoff point of, say, 15%. So the max your HELOC could go is 15%. So let's say 8% or prime is the lowest, with a max of 15%. There is very, very little unsecured HELOCs out there at banks that have a max anywhere near 15%. It's usually like 18% or higher. So we can compete, again, if I'm the bank, I would compete and set my max to like 14, 15%, something like that. And encourage folks to move their business, move their banking all to us. And then I know that if I'm in partnership with content creators like Denzel, who are teaching my customers how to properly steward their funds, they're going to move more and more and more of their deposits to us. But we need to set it up that way. Okay? So that is a unsecured personal line of credit, where it's like a prime plus because it's unsecured. And the only way to get to prime is having great credit, moving your banking with us, direct deposit, and setting up auto pay, overdraft protection. You know, you got to move, say, 50% or more of your direct deposit. So I would say, yeah, so 50% or more direct deposit of that individual's paycheck. So it's like encouraging velocity banking. So ideally you want to move 100%. And then that's how you get to prime. If you do 100% of your direct deposit with that bank, now you're at a prime, very similar to a secure HELOC. But now that bank is winning because they're getting all your deposits. So they win there, and they're winning because they're creating a lower interest rate compared to all your other debts, and they know you're going to consolidate all their debts to you instead of going with a debt consolidation company, instead of, you know, refinancing debt with these lending tree, you know, Cabbage, all those ridiculous institutions that charge massive loan rates in the double digits right now. Next, this is exciting for me. I think this is going to be really cool. But what if we could design a credit card? And there's only very few credit cards that operate this way. But what if you could have a credit card, unsecured, that functions like a HELOC? Meaning fully revolving, you can do direct deposit, let's say, to the credit card. You'd have a checking account attached to the credit card. So it's a credit card and a checking account attached. You direct deposit your income, it goes to the checking account, and it would sweep into the credit card. You can have the credit card actually in your wallet, and you can use that to pay all your bills, even your mortgage, even your debts, even other credit cards. Because for those bills, like a mortgage or a car loan or other credit card payments, the bank would sweep it out of the available credit of the credit card and put it into the checking account that you would set up with them. So essentially, it's the same thing as an unsecured HELOC. Difference here is because it's a credit card, we got to bump up the rate. So it's not going to be anywhere around no prime plus 1. It's going to be in the double digits range. But here's where we can compete with all the other credit card institutions, right? Remember I said you got average credit card rates today are what? 25% and up minimum. It's like legal usury here when it comes to credit cards. People are getting charged 30, 33, 35% is the highest rate I've seen on a credit card, 35%. What if we could design a credit card where the max interest rate no more than 20%. What if it's something like that, or maybe a little bit less? Something very competitive. Max 20%, minimum, depending on credit, say maybe 10 to 12%. And then for certain kinds of clients like military, police officers, firefighters, nurses, first responders, we could do like what other banks do for those folks is like do an even lesser rate, like a 0.% difference, something like that. Now this kind of credit card, because we're providing such a good rate compared to all the other credit cards, there's no, let's say no cashback rewards, right? Because it's going to function just like a PLOC. A PLOC doesn't have points or cashback rewards. It's still going to build credit, right? Because again, I'm thinking like a bank, right? I can't give too much because the bank still needs to profit. So if you had a credit card where you can essentially do balance transfers without paying cash advance fees or convenience fees, so that would be the attraction here, is no balance transfer fees, no cash advance fee, because you're not doing a cash advance and you're not doing a balance transfer. You're just literally doing a transfer from your credit card to a linked checking account at my bank in this example. Because again, all of these products are gonna attract the kind of customer that's like, yeah, I'm fed up with Wells Fargo, I'm fed up with Chase, Bank of America, these big banks, Truist. I don't want to do business with those banks. I want to do business with a bank that appreciates my business and is going to reward me with better products, better tools for me to accelerate my wealth. And I'm more than happy with that bank making money off of me because it's a mutual beneficial relationship. It's a win-win scenario. So if you had a credit card, no cash reward system attached to it, credit lines go up to, maybe they cut off at 50,000, maybe 75,000, and you're able to pay other credit cards, your mortgage, your personal loans, your car loans. You can pay anything that you normally would not be able to, even your rent, you'd be able to pay through a credit card. And the only reason why is because we've got a checking account attached to the credit card. So it's a sweep. So the checking account, you set up auto pay, you'll have the ACH and routing number that you would give to your mortgage company, that you give to your other credit cards, that you would give to your car loan provider, and all your personal loans and student loans. And what would happen is automatically the bank would auto sweep money out of your credit card as long as there's available equity in the credit card and it pays all your bills on time. Meanwhile, you're directly depositing your income to the checking account and then it auto sweeps to the credit card by midnight. And because it's a credit card, you're not getting charged the interest daily. It is accruing interest daily, but won't be charged until the due date. And because it's a credit card, it's based off of the statement cycle. So you could very well manipulate this, where maybe you ran $10,000 on the credit card, but in the statement cycle, it was only $5,000. So on the due date, the statement balance owed is $5,000, even though you owe total $10,000 on the credit card. So what does that mean for us as Velocity Banking practitioners is, as long as you pay the $5,000 on the due date, you don't get charged interest on the other 5. Unlike a PLOC, whatever's owed is whatever you're getting charged interest on, and then that's what's due on the due date. If you don't have it paid off, right, you're getting charged that interest. No matter what, you get charged interest. So if I took $10,000 out of my PLOC at 8% for a few days and then threw it back in, I'm going to owe interest no matter what. But with a credit card, if I run it up, pay it back, pay the statement balance in full, I get charged no interest. So essentially the credit card starts looking a little bit more attractive than the PLOC, right? But on the credit card, it's going to be a higher rate. So maybe max 20%, and that's, let's say, if your credit score is under 720, then you'll be at rates between maybe 17 and 20%. But if you're at a 720 or higher credit score, maybe we put you at around 10 to 12%. So it's still going to be at a higher interest rate than a PLOC. But with the credit card, if used properly, you can finesse your way out of all the interest altogether by making sure you're always covering the statement balance. So you can do micro chunking, small chunks, to consolidate a credit card for like $4,000, put it in here, only pay interest for like 1 or 2 months, let's just say, or not even a full month. So that is a credit card that functions like a PLOC, that has auto sweep attached. So it's a checking account and a credit card combined in one. In order to get that product, one has to meet these requirements. 700 credit score or higher, has to open up a checking and savings with us, has to set up direct deposit with us, 50% or more of their paycheck, right? They have to want to do business with us. And we're creating these in-house exclusive products only for those that bank with us. And some of the benefits of our credit card is no balance transfer fee, no cash advance fee, no convenience check fee. You don't got to worry about that because you're not even doing any of that. You just have your standard rate, whatever it is, no cashback rewards. Strictly, it's operating just like a PLOC. So let's say someone didn't qualify for the PLOC, they would qualify for a credit card PLOC. That's how that would work. So you can make an argument like, okay, secured and unsecured are like the best options from an interest rate standpoint if I qualify. If I don't qualify, then my next best option, so the bank would say, hey, you didn't qualify for the unsecured PLOC at prime, but you do qualify for a $10,000 credit card unsecured at 18%, 17%, which is still significantly cheaper than the standard interest rate across the board. So if I'm talking to someone that has average credit card interest rates of 29% and up, and I'm saying, hey, let's shoot for an unsecured PLOC over here, maybe we can get 8 or 9%. And if we don't get approved, the bank would guarantee us a $5,000 or $10,000 credit card, let's say at 17 or 18% with a max of 20. So now we can start consolidating some of your credit card debts that are at 29, 30% or more, save you money on interest. Now you can do velocity banking with a credit card, full velocity banking, not halfway. So you're mind you, all my content talks about velocity banking with a credit card. There's limitations to that. And I always say you don't want to stay there. You want to eventually graduate to a PLOC or a HELOC, okay? I hope this is good. I hope you guys are enjoying this. Let me know in the comments if this is like, whoa, I never thought this could be possible, and here we are, or this could be a potential opportunity. And I thought, you know what, let me create content. Let me just put it out there. Let me pitch this bank. Let me pitch this institution and see if they run with it. And if I get to be a part of it, all I want to do is be in the room. That's all I care about. And serving you all, getting the best products. And I know I got to play ball on both sides, right? Just understand, like, everything that I'm presenting here is significantly better than the standard of what's out there. And it's still very much profitable for the banks. Still. But most banks are very greedy. So last, we have a cash value line of credit. Now let's look up average cash value line of credit. Average cash value collateral line of credit interest rate. Let me share my screen. See what comes up. So the average interest rate for a cash value collateral line of credit can vary depending on the specific lender, the amount of collateral pledged, and your individual credit worthiness. However, generally these lines of credit tend to have lower interest rates than unsecured loans, as the lender is protected by the collateral. So we got securities-backed line of credit, 2.5. That's like a little example there. Let's see if we can get maybe a little bit more information. So I think I gotta give it a different name. Insurance-backed line of credit. And, oh wait, we also have Valley Bank right here. I could look them up. Let's see if they show it. So we got lines ranging from $70,000 minimum to as high as $5 million. So we can use that as an example. Now, typically, the lower the line of credit, the higher the rate will be. The higher the line of credit, the lower your interest rate will be. So here's what we know about cash value lines of credits. In some cases, the rates are typically at prime or prime minus, and that's dependent on line of credit amount. So the way that I would compete as a bank compared to all the other banks that are doing cash value line of credit is I would just have a standard of prime minus. But I would set my collateral amount higher. So I would have minimum 100K or more. And you'll be at a prime minus 0.5%, 100,000 or more. 250K would be prime minus 1%. Then I do 500K prime minus 1.5. So I probably do it in 0.5 increments and do it every $250,000 or more. And then probably cut it at 2.5 or 3% below prime, because I'm looking to compete, especially as a bank, where this becomes extremely attractive is you also have to look at policy loan rates. Again, this would be an in-house product, and I would set the same standards. Look at the credit, has to have a minimum line amount, 100,000 or more. You need to set up checking and savings with us, set your direct deposits with us, 50% or more, to get these in-house products. And I think customers would be more than happy to do this, especially if I'm the one encouraging people to maybe go to this bank to say, look, here's where this makes sense. Here's where this makes sense. We can do this. We can do that. We've got all these options here that we can look at. When it comes to cash value lines of credits, cash value collateral line of credit, you have to look at the policy loan rates. Some life insurance companies, when you borrow and you get a loan, sometimes the interest rates could be between 6 and 8%. The lowest that I've seen in the industry is 5% or like 4.72%. That's usually with the bigger life insurance companies. That's kind of like the lowest. But I want to say the average right now, a lot of companies are like 5.8, 5.5 to 8% range. So ideally, as a policy holder, if I could go to the bank and let's say my loan interest rate is 6%, but I could get a cash value collateral line of credit for 5.5% or 5%, now I'm paying less interest if I borrow the money out and go do something with it. Plus, it's a revolving line of credit, so it's faster access to the cash than when you borrow out of your policy with a loan. It takes a few days to hit your account. You're not really doing velocity banking. So the repayment strategy is slower than with the cash value line of credit. And I would try to compete essentially, where you start out prime minus on 100,000 or more. Most in the industry that I've seen so far, when it comes to a cash value collateral line of credit, it's prime plus under $250,000. When it's above 250 grand, now you're at like a prime flat, I think, or like prime plus 0.5%, and or like prime minus 0.5, depending on the different bank that you might go with. Some also do, I think, like an intro rate, and that would be a way that I would also, try to capture businesses, offer some kind of an intro rate. I would do that with the cash value line of credit, and I would also do that with the personal line of credit. The credit card that's operating like a personal line of credit. I would try to throw in some kind of an intro rate offer of like 0% for the first 6 months, 12 months, something like that. Again, not offering any cash, rewards or anything like that, and go from there. So again, this is a way for a bank to receive more deposits, pure cash, from customers like yourself that are sitting on high yield savings. You're sitting with savings accounts at banks that are paying you nothing. And we could put that money to work by collateralizing it, securing it, getting a debt tool at a very low interest rate compared to all your other debts, and we start the acceleration process. Because what happens when you're doing velocity banking on an 8% line of credit or a 6% line of credit? Are we actually paying 6% total in a year if we're doing velocity banking? The answer is no. You're getting charged 6% divided by 365 days. So you're getting a daily charge of 0.000 something. Okay, that's your daily rate. And you're only owing what you leverage out of the line of credit for a certain period of time. What you initially borrow out immediately starts to get paid down in the first month. So when you look at a total year, your net percentage cost of interest might look like 3%, 2.5%, 4.5%, 1.5%. I had a collateralized cash value line of credit 2 years back. I want to say my interest rate was like 7 something. This is when rates were like, prime was, really high. I think this is when prime was at 8.5%. And I had a cash value line of credit, I think it was like 7.5 or 8 or something like that. But my net cost of borrowing throughout 1 year was as low as 3 or 2%. So I was dramatically reducing that rate. And again, with these products, secured, unsecured, credit card, cash value line of credit, this is how I would open up business if I was a bank wanting to receive deposits from this particular community of people that understand leverage, that understand velocity, that understand infinite banking. Okay, the infinite banking, velocity banking community is growing dramatically. Why? Because more and more people are becoming aware of the system that they live in, the banking system that they live in, and it's not set up for their success. The products are not set up for their success. The education, anytime you guys call and you're like, hey, I'm interested in the HELOC, they want to sell you a home equity loan. They want to tell you to do a cash out refinance instead because they want to hold you in debt. Versus what if you could partner with a bank that doesn't necessarily want to hold you in debt forever, because they know that if I have more depositors that are smart borrowers and even smarter lenders, they'll keep storing more of their cash with us. And we give them great products to go be great citizens and value creators out there in the world. We don't need a bunch of peasants. We don't need a bunch of uneducated. We don't need to keep the people like slaves, like peasants, uneducated. We don't need to do that. And what we're seeing right now, in the grand scheme of things, when it comes to banks, majority of banks look at you all, us all, like slaves. We're peasants. We're borrowers in debt to our lenders for our whole life. So the bank thinks long term, it's like, yeah, let's offer them these terrible loan products, high interest rates, lock them in, and have them as trained peasants to just make monthly payments every single month. Trained slaves every single month. And we'll make billions and billions, trillions of dollars over multiple generations. That model is going to break soon. When it breaks, it's not a matter of if. I'm telling you, when it breaks, here's where conspiracy theory comes into place. We're going to see the world reset and we go to a one world currency. Because the overall big systems can't allow too many people to be sort of rebellious. So they're going to have to eventually change their ways, and they'll encourage us, they'll reaffirm us or whatever, and then they'll come out with a one world currency, one reserve banking, right? One type of digital banking system that we'll all convert to, and it's safer and more secure. And again, it just keeps you in the slave peasant role, just paying your bills, paying your monthly payments on the time. Versus there's going to be rogue banks that are going to operate outside of the central system. Communities like the velocity banking community like this and the infinite banking community are going to be aware. They're going to already be awake to this stuff, and they're looking at the alternatives. What are the alternatives today? Store your money in whole life insurance. It's more secure. You don't have to worry about FDIC insured. All of your cash value is guaranteed by the death benefit, guaranteed to be there by the insurance company. The insurance company can't do fractional reserve lending. They're more regulated than banks. Life insurance companies rarely go out of business. So you have all these protections, which is why people are pulling their savings out of banks and dumping it in whole life. Newsflash, where do you think banks store their money? They store their money in whole life policies all day. It's called BOLI, bank-owned life insurance. That's where they store it, tier 1 asset. Look it up. So you get to play that same game, but now you get to partner with a bank that knows what you're doing and encourages it by designing phenomenal products for you to succeed. Because they're like, if we have free thinking customers, entrepreneurs, high performers, high income earners, good credit scores, great borrowers, we're going to have retention. And then we're going to have word of mouth. We're going to have that word of mouth. That means that family will bank with us for 30 plus years. And we'll continue to reward them. For example, we could set up referral programs where if you sign up 3 accounts, you sign up 5 accounts, we'll reduce your credit card interest rate by 2 points, 3 points. We'll reduce your line of credit by 0.25%, 0.5%, and keep it there by bringing us 5 accounts, five new, and maybe that 0.5% decrease stays there for a year, let's say. And as long as those 5 accounts maintain business with us, every year we'll keep your 0.5% discounted rate. So it's like having an additional discount on top of everything else. Wouldn't that be cool? So I want to see where your head is at in the comment section. By the way, the institution that I'm pitching to, if they watch this and they see this, they're going to see your comments as well. And they want to know the feedback of the customers. What are they thinking? What do they need? And this stuff pumps me up. Okay, I get really excited. So I'm going to see, let's see. I stopped focusing on cash back because I realized I would justify unnecessary spending. Now I just use cards with no cash back and allow me to do no fee cash advances, no more than 18%. Okay, so Jesus would be a perfect customer for this institution, this bank, where it's like no more than 18%. What if we had that minimum below that? Same method. So there's a bunch of people out there that watch this channel, Christy, Quox, Kana J, that we've been teaching y'all how to use these banking products. Could you name some banks that offer credit card / HELOCs? There isn't. That's not a thing yet. The only thing that does exist is credit cards at credit unions where they don't have a balance transfer fee, which means that you can do what's called a direct deposit advance to a checking account, or you can do a balance transfer to another institution without paying the balance transfer fee of typically 3 to 5%. So you get to avoid that completely. And you would do semi-velocity banking. You can send some of your income to the credit card, or in some cases, you could technically send all of it, but you have to be strategic because when you do that balance transfer, you got to have, good timing. And if the balance transfer is only allowed where you don't actually get it directly deposited into your checking account, but it's only a balance transfer, meaning it has to be sent to another institution, you may not want to dump all your income. There is a bank called Cornerstone Federal Credit Union, if I'm not mistaken. Let me look them up for you. This would be an example of one bank. So we got think it's Cornerstone. Yeah, Community Federal Credit Union. Look at their credit cards. Look how low their rates are. 9.9, 8.9, 7.9. That's extremely competitive, right? Visa Classic, Gold, Platinum. Make room in your wallet for a Cornerstone Visa credit card with low member only. See how they do it? Got to be a member. Only preferred rates as low as 7.9% with no annual fees. Because we are a credit union, we can offer lower interest rates than traditional banks. There's no better time to pay off balances and consolidate your credit cards so you'll have one monthly payment and no annual fees. Want to see if cash advance fee is only 1% higher than the fixed APR rate. That's not terrible. Okay. I think with this bank, I don't see it on here. Let me just see if I can apply. I gotta put all the information in. That's not gonna work. But yeah, I think this is a bank where you can do balance transfers, and I don't think they charge a balance transfer fee. So again, my rule of thumb is you're only gonna find that at local credit unions. I preach this all the time. Local credit unions, local credit unions, local credit unions. Start in your state. Do a little 25-mile radius check with Google and find local credit unions, and then look at their credit cards, look at their interest rates. They're typically lower. Okay, they start off lower, and it's for their members only, because a credit union is a non-for-profit bank. So if we could partner up with non-for-profit banks, credit unions, small banks, then we're able to do business at cheaper interest rates. You're able to save a ton of money. So again, there's no such thing as a credit card personal line of credit, but there are credit cards that function like a PLOC, and the parameters are no balance transfer fee, and you can do direct deposit advances to a checking account without doing a cash advance. So without paying a cash advance fee or a higher rate, you can just take the money out of the card into cash. It's now in the checking, and then you get to do whatever you want with it. And the bank lets you do that multiple times over with no balance transfer fee. So you're able to do somewhat velocity banking with that until you can graduate to the PLOC or the HELOC later on. Hope this venture works out for you. It sounds too good to be true. Of course it does, right? No one's ever heard of this. But you got to realize what's been happening the last decade. The last 10, 15 plus years, velocity banking has picked up tremendous, what do you call it? Speed, trajectory, whatever. It's picked up a tremendous amount of attention and market share. Let's look at first position home equity lines of credits. There's still only a handful of banks that offer a first position home equity line of credit. A handful. There's 3 institutions that do a first lien HELOC with what's called a sweep account that I know of. I think PNC Bank might have a sweep account function. I'm not too sure. But even that, the whole sweep account function thing, which means that there's a checking account and then you have your HELOC. And by midnight, any money you have in your checking account gets swept into your HELOC to bring your HELOC balance down to reduce your interest costs. That's a game changer. That reduces interest quite a bit. This is solid info. Is there ever a situation where consolidating unsecured debt into a close-ended loan for a lower interest rate to cut down my minimum monthly payment to free cash flow? Consolidating unsecured debt like credit cards, like a HELOC, like a personal loan into a close-ended fixed amortized loan for a lower interest rate to cut down my minimum monthly payment to free cash flow. So it comes down to preference. Is that something I would prefer to do in this season? So I've had clients consolidate a lot of their debt, unsecured, secured, into another unsecured loan, essentially. Fixed payment, lower interest rate, lower monthly payment. They then took the excess cash flow and now we're investing it, or we're doing something with the money to then come back and pay off all this debt later on. So there are situations where that happens. You really need to process, is this something that I'm looking to do where I just need to get all this debt into one location, one payment, and then have no intention of, say, accelerating that, but now I freed up all this cash flow here, and you need to have a second strategy, which is, what are we doing with that free cash flow? Are we now taking that free cash flow and paying it toward this new loan? Most of the time, that's not going to make sense, even if you went to a lower rate. You probably would have been better off doing the chunking method with velocity banking than to try to consolidate all at once. Because a lot of you do terrible math. You think consolidating 8 to 10% to a 6% amortized loan is cheaper interest. Often it is not, because you have an origination fee in there and you're essentially resetting the clock. It's an amortized loan for 7 years, 10 years, whatever it is. Over the long haul of that, you didn't do anything. Many of you didn't do anything when you think you're saving money, versus instead of using your credit score to apply for that loan, why not get yourself a HELOC? Why not get yourself a credit card that's like a HELOC, or a home equity line of credit instead? Why not be patient, build your credit so that you can qualify for the better tool, and now you did it in chunks and stages and got the better result. So you've got to sit with that. You got to process it, see what makes the most sense. The most underrated revolving debt product might be the secured HELOC. Imagine if lower income people, instead of spending tax return, got a secured HELOC and knew how to leverage it for the whole year. Dangerous. Absolutely. The secured HELOC is a super underrated financial product for anyone that, let's say, doesn't have debt. They can build credit and access to capital safely. Someone with some debt, no mortgage, but a ton of personal loan debt and credit card and student loan debt, could use a secured line of credit to start chunking away at their debts and remain liquid in the process. Super cool. This is my long-term strategy, which would be to do traditional velocity banking with a HELOC, but my current income is not that stable, so I don't want to do velocity banking yet until I have higher income. I have access to a couple of HELOCs, but around 19%, which is around the average interest rate of my credit card, within a few percent. Will it make sense to get the close-ended loan? Yeah, so with unstable income, super high HELOC, here's the thing. Should I even be forcing velocity banking? Let's also review that. let's line up making extra payments on your existing debts that you have. How long will it take me to become debt-free? We look at that. We know Tim's not doing velocity banking as of right now, but he's got these PLOCs. So I don't know if we owe money on those PLOCs. Let's say he doesn't. So it's just sitting there. That's fine. No need to use it. And he's got some credit card debts, but he's got fluctuating income. So he's got fluctuating cash flow, and he's looking for some relief. I could do that. But again, you've got to use your credit to get the consolidated loan. Where could I simply be patient, be still, and eventually acquire a PLOC nowhere near 19%? When did I get those PLOCs? Did I get those PLOCs a couple of years ago where interest rates were really high and my credit score was super low? And that's why I have a terrible PLOC? Because what does Tim have? He has an inefficient line of credit, so velocity banking is not attractive for his situation. What if he had a PLOC at 10%? Those exist. 9%? Those exist. But how do I get there? Having better credit. How do I improve my credit? Hiring someone to improve my credit and then pay my bills on time and stay patient. So if I'm willing to be patient and stay in the fluctuating income, okay, my cash flow is different right now. Maybe I just simply need to focus on saving money to provide myself a better financial cushion, maintain all my debts, pay everything on time, improve my credit. Once I get the better credit, then I transition and ultimately get a much better tool. So that's something we can process. Look what Jesus said. Yep. It's exactly what he says. Boom. Exactly right. Joy said facts. Yep. Interesting point. Yep. Cool. So Brad says Avon does home equity line with credit card. Here's the problem, and I've made videos on this. Avon is a terrible home equity line of credit to use. You see, because we're not reading between the lines. So I'm going to make another video, and this is going to be a little short clip right here. Why Avon is not a good tool to do velocity banking with. It's horrible. I will keep preaching this, because here's the thing. When you look up home equity line of credit, Avon pops up, Figure pops up, because they're providing the most amount of marketing right now. So I'm going to clear my board a little bit, create some space, and tell you why Avon is a bad idea and you shouldn't do it. You should not get a home equity line of credit with Avon if you want to do velocity banking just because they offer a credit card. So let's look at it. Let's go right to their website. Let's see where they're at with their rates so we can learn together. Here we go. Avon, credit card in the front, home equity in the back. Max credit line, $250,000. You can get approved in as little as 15 minutes. That's pretty attractive. It's a credit card, so you get 2% unlimited cashback rewards. Your interest rate is anywhere between 7.49, which is prime, to as high as 14.99%. Let's say you got great credit. Let's say you got the 7.49% rate. Let's say you got $250,000, and we got the credit card function with it, which is 2% cashback rewards. Okay, here's the problem. The first problem with Avon. Where do you see checking account? Avon is an online bank. They do not have a physical location. They do not have a checking account. So here's what happens. See this right here? In order to access cash out of your HELOC, because remember, a credit card cannot pay for everything. Credit card can't pay your mortgage, credit card can't pay your property taxes and insurance, credit card can't pay, your car loans and all your other debts. So what do you have to do? Well, you have to do a direct deposit. Well, you can do that with Avon. That's not the issue that I'm making here. I'm saying it's the way you do it. It says cash out to your bank. So if you work with Avon and you're doing business with Bank of America, you have to wait days to get money from Avon to your Bank of America bank account. And then guess what? It says no gotchas. That's just hilarious. This cracks me up. It says no gotcha, just a 2.5% transfer fee. That is hilarious to me because I'm like, wait, that's a gotcha. What do you mean? So every single time you transfer cash to your bank, you're paying 2.5%. And if you're doing velocity banking, this is terrible. This is a massive drag. Every time I gotta pay 2.5%. Every time. That compounds to where you end up paying 10, 15, 20% in transfer fees throughout the whole year. So you have to factor that into your costs. Now, some might say, well, aren't I getting 2% cashback rewards? Yes, you're getting 2% cashback rewards, but on what? How much of your bills can get run on that credit card? So if you're only running $3,000 a year and you're getting 2% cashback rewards, let's run that. Let's see what that looks like. A perfect example why this is just terrible. I'm telling so many people, don't do this. So let's say with the Avon credit card, you're going to run $3,000 worth of bills. And I think that's $60, right? Yeah. So you get $60 cashback rewards. But then you have $4,000 of bills that can't be paid through the credit card. So you're going to pay 2.5% every month to pull out of the HELOC. That's $100 times 12. That's $1,200. You created a new expense. You're getting 60 back. So, okay, you could say we reduced that 1,200 minus 720. I reduced it to 480, but 480 is still a cost. You still see that cost initially. So you increase your cost of living by $40 every month, let's just say. And then the fact that Avon is not a bank, is an online bank. They don't have a physical branch location. They don't have checking accounts. So it takes days for you to transfer that $4K to pay your bills. And what are you paying? 7.49%. So you have to add those two together. So you're paying 7.49% on all of the money that you pull out of the HELOC, right? Because the credit card interest rate is charging you 7.49%, and then you're paying 7.49% on any money you borrow out plus 2.5%. Uh-oh. So do 4,000 times 7.49%. Divide that by 12. So that's 2496 on that. And then 3,000 times 7.49%. 1872. Add that up, add that up. What you start to realize, and not a whole lot of people I see even get the 7.49%. Some of you are in the 14 range. I see most people getting 14.99 and double digit rates, and I'm like, it's inefficient. You're just creating an internal expense in there. They're tricking you with the 2% and the whole credit card function. But I'm telling you, that's a sleight of hand. You're getting destroyed on that. So many of you should not go with Avon, and you should go back to my educational videos on credit unions, credit unions, credit unions, credit unions. They're going to offer intro rates, no closing costs, better rates, immediate access to cash because you'll have a checking account attached to the HELOC, so you do instant transfers in and out. And some of them also give a credit card, which does make it easier. So that's my spiel on why you shouldn't work with Avon. And Avon is just like Figure. I would not do business with Figure either. There's a few credit unions and banks that let you use a credit card for overdraft protection. Yep, that's true. I love credit unions that have the customer in mind, yet literally a credit union is designed to have the customer in mind because they're a non-for-profit bank. Okay. North Point Bank is a great bank as well. They do a first lien HELOC. About the origination fee, Tim, ignore my comment about the car loan. Thanks. Cool. Okay. Smaller term. Yeah, okay, got it. I think I hit all the questions here. So as it relates to right now, because this was like me manifesting for the future, this is me pitching a bank organization to do business with me, to have me in the process of potentially designing the best lines of credits to attract new customers, to attract a whole new base. Can you imagine? Like all of the velocity banking channels would point, go here, because they're offering the best products, period. And what's that going to do? That might spark competition. Other banks may feed off of that. And then when you've got competition, guess what? You got different, product offerings and things like that. And it makes it very, very highly attractive to do business with banks that want to do business with you, that want to see you actually create wealth and be free of the bank and need them when you want to do partnerships. And I think we're stepping into that season in the next 10 years or less. We're going to see more banks providing actual financial literacy and education, non-traditional financial strategies like velocity banking and others, even infinite banking, and encouraging it. Because I think it's better to have customers who are free thinkers, high performers. They're going to better society and ultimately make more money for everyone. Like if you make money and I make money, we make money together, who's losing? Like more people make money. There's more wealth. Now, in the present, for the time being, for those of you that are looking for the best line of credit, you're searching, you're researching, you need help, you need coaching one-to-one, reach out to me directly. Happy to help you, happy to serve. We can make that happen. If you're going to do it DIY style, please go to my channel directly. Click on my profile name, go to playlists, and look for the playlist that's titled All About the Line of Credit, Velocity Banking Pregame Work, Velocity Banking with a PLOC, Velocity Banking with a HELOC, Velocity Banking with a First Lien. So if you're looking for a First Lien HELOC, I have a playlist all about that. breaks down the different companies you can work with, you can reach out to. I got links below on my website and in the description to help you, ultimately make the best decision. And I always tell people, don't apply right away. Get as much facts as you can. Once you've decided on the bank, don't apply yet. Open a bank account with them. Build a relationship. Move your direct deposits over. Move your savings. Move your money to that bank. Then apply. So that when you get access to the tool, you immediately go to work. You've got all your money there and you start the flow. You start the process and you're gonna have a lot of fun. Okay. I don't see any other comments. How you doing, Antoine? First live stream. Good to see you. So I think we had 2 or 3 live stream first timers. Stay tuned. More content coming. God bless you all. Thank you for your time today. And I will keep you updated with this organization that I'm talking to potentially create some really unique financial products that I think would really improve people's finances and teach them how to be better borrowers while they're borrowing debt for the time being. It's part of life. Borrowing debt is a part of majority of Americans' lives. Instead of being afraid of debt and fearful of it and trying to avoid it, why not just master it, control it, make money, make wealth from it, and then become completely independent where you don't need them? And it's just a matter of leverage. It's like, well, me leveraging their money, I can make more money than me just putting my own money at risk. And you start to think differently. And then we become lenders. If we become lenders, what's the opportunity that we could all come together and build banking systems? And this is what I've been doing the last 7 years, helping people build their own banking systems with whole life policies and lines of credits. The next stage up from that is literally being able to have an actual bank financial institution. We may not see it. I may not see it in my lifetime, but if I put the proper tools, resources, and people in place, the next generation might be able to see it. And that's how I think. Where it's like I'm doing things where even if I don't see the fruit, but there's a guarantee that my heir, that the next generation would see the fruit, and then that's all they know. Like that's their new culture, is they go to Bank of Rodriguez. They don't go to Bank of Wells Fargo, because that's a name, by the way. That's a family name, Fargo, or Chase, or Morgan, or Stanley, right? Bank of America. Those are all names. Versus Bank of Rodriguez. If the next generation, that's all they knew. Oh yeah, we only finance from the Bank of Rodriguez. Money rotates and stays within that economy. Wealth is multiplied over and over and over again. It's amazing. I leave you with that. Again, you can reach out to me one-to-one. I do a lot of one-to-one work, a lot of workshops. Happy to serve, happy to help. Reach out to me directly, email me. Put me in, coach. Put me into work. I'm trying to work. Okay? Like I'm in that season where I am just really putting in the work. I'm available. I'm here. Been doing this 7 years. Like I'm literally not going. I literally have not changed my message the last 7 years. It's helping moms become debt-free, build wealth, leave a legacy, build your kingdom. And that's blossomed into helping families, all walks of life, all age groups. My knowledge has expanded, where now I'm teaching about retirement and other cash flow strategies and investing in different financial vehicles where you can store money and multiply it. So you're getting me, especially those that are new clients now, you're getting me at a time where my knowledge is even higher, so my service is even higher now compared to clients that know me since day one. I used to be like a one-trick pony. Now I've got multiple tools multiple levers I can pull on to help you in your situation. So please don't DIY forever. DIY is great because it's free. Don't stay there in DIY because then you limit your capacity and your potential. Bring in a professional, whether it's me, whether it's Christy, whether it's the Kwok brothers, whomever. Bring someone in so that we can help you get to the next level. And then when you win, others can see the possibility, the hope that they can win too. It's not just me saying it, but it's my clients saying it as well. I can't wait to bring some clients on my channel and interview them. And so it's not just me saying it. So I've had that happen before. And if you're a longtime client and you're willing to get in front of the camera and share your message, your testimony, and what you're doing, I'd love to have you on. With that being said, God bless you all and have a wonderful evening. We'll be talking soon. Bye now.